Our next guest says the sell-off in Treasuries was pointing us in the right direction and that prices will continue to drop for the rest of the year. His target for the 10-year, 2.75%. Joe Balestrino helps manage $15 billion in assets at Federated Investors. He joins us right now. We got Morgan Stanley's Adam Parker still with us, continuing on. You know, Joe, you've been dramatically reducing your position in Treasuries. Tell us your overall thoughts on the landscape for this group right now.
Yeah, we really have been, and our landscape is very simple to us. It's now been 5 to 6 months of continually better than expected economic data. So the reality is we came into this year with a Treasury market that had completely decoupled from the fundamentals. So either it had to catch up and go up in yield, or frankly, Europe was going to take down the world. And we didn't think that was going to occur, and we don't think that's going to occur. So when we're looking for 2 3/4, that implies nothing more than 2 to 2.5% GDP growth, and rates trend up in that direction. We don't think we're in a bond bubble, but the best days are well behind us.
Bond bubble, that's an interesting way of putting it. Adam, you cover the equity markets, but, venturing here into the bonds momentarily, do you think there could be some kind of brew of a bubble? I mean, has there been just so much angst and so much worry out there? Or given your bearish scenario, do you think it's justified?
Look, to me, it's pretty clear why the 10-year was low. The government had a policy to create trillions of dollars on a computer and buy their own securities to suppress it. So to me, the 10-year should be low. And moreover, I think the chance that deflation occurs is real. So if you're bearish, obviously you think deflation's got a chance. I do agree, though, and investors constantly mention it, that, hey, equities could just be the best house on a bad block, and you've got to put your money somewhere. The problem is you can't empirically show that. You can't show, actually, that inflows into equity markets actually drive it higher. So I don't see any big inflows in the equity market from our data, from either retail or mutual fund, and I still think money's flowing into bonds.
Wait, did you just say that you don't think that inflows into the equity market will actually drive it higher?
I don't think so, Trish. Look, I mean, the equity market bottomed at 666, and it rallied up from there while there were massive outflows the entire time. So clearly there's more going on.
So it works the other way, too. But, yeah. I guess I would just counter that by saying you still got all this money on the sidelines. What happens once that whole group says, you know what, I want to be in there. I think this market actually is taking off, and I've missed it the last few months, so now's my time. That money comes in to go to work. Then wouldn't you logically see the market start to sputter higher from there?
It could. I mean, in the past, there's been times where that's occurred, and in the past also there's been times where that represented the top of the market. So it's just not clear from the data that works.
Hey, Joe, one of the most consistent trades over the past 6-7 months has been bonds, 10-year bonds, 180 to 210. You bought them at 210, you sold them at 180, back and forth, back and forth. Now all of a sudden we get this move to 240. Are we creating a new range here?
Yeah, I don't know, Adam, that we're creating a new range. I think that might be a sucker's bet to say, okay, we've zoomed back up, if you want to call zoomed into the 230s, a high level. Don't think so. I think it's the trend. And if you think we're in a bear market, playing a range can be very, very painful because, as you say, you would have bought it at 205 or 210 just in the past 2 weeks and been bloodied up pretty badly here. I think you go with the economic data. Ultimately, in our business, all asset classes come back and reflect fundamental economic data. And as I said earlier, the bond market's not yet done that. And the stock market, obviously, have valuation issues that you have to contend with. But to flows, the one thing I would say that we see here at Federated, and frankly, we see in the entire bond fund industry, maybe it's the Chicken Little approach. All of our higher yielding bond asset classes have had material flow upticks inflows, so much more cash flows coming into high yield, emerging market debt, multi-sector strategic income funds.
But isn't that just a desperate search for yield, Joe? I mean, the investors are saying, hey, that Treasury is really not going to pay me much these days. Maybe I need to look at high yield. Maybe I need to look at emerging market debt.
Yeah, it probably is, Trish, because the reality is there's only 2 ways to increase your yield. You have to take exposure either out the curve or down the credit quality spectrum. For our money, we much prefer the latter approach to the former.
I guess one of my big questions that I keep coming back to is what I don't understand is why the bond market has not recognized the economic gains that we've seen thus far this year, so, such as the equity market has.
But I think there's an answer to that, Trish. I think it's the GDP isn't as good as the jobs data. So the jobs data has been incredibly strong. That's what the equity market's reacting to. But the GDP, our forecasts say it's tracking at only 1.7% this quarter. So, the bond market's more of a GDP. be kind of correlated to GDP, whereas the equity market's looking at jobs, and the truth's probably in between.
Well, here's the other question for you, Adam. Is there some sort of effect where it's like a coiled spring? In other words, you know that if Chairman Bernanke is keeping rates low through 2014, you're not going to push the 10-year that much higher. But if he were to change that view, do you think that uncoiled spring would release and take yields higher?
Yeah, it easily could. I don't think the Fed really wants you to take your expectations that they're moving the front end up very much. I think they're going to be pretty careful on the language there. They want you to think it's not going to be for a while because they want to fan the embers here and make sure the economy moves. Our call, and I think it's pretty contrarian at Morgan Stanley, it's Vincent Reinhart's call, our chief economist, is that you will see more unconventional policy in the first half of this year. So that wouldn't be consistent in our view with 10-year yields gapping up materially.
All right, Joe, final word to you. You're looking at 2 3/4 on the 10-year. When?
When? In the next 2 quarters, I think we gradually just trend in that direction. I would not play a range. That range is going to be continually ratcheted a little bit higher as the data comes in as we expect, which is not a great expectation. Yields have to go up. And in the meantime, Europe will probably fade out of the mainstream headline every day, and that's all it takes.
All right, we're going to leave it there. Thank you so much, guys. Joe Balestrino, Federated Investors.